We always wonder sitting on the other side of the fence how the rich manage to stay so rich. Don't they have to pay really high taxes for all the money that they earn? Well, this video will explain to you how they legally get away with paying virtually no taxes. Here are 5 ways they do it, and to save on your taxes, maybe you too can try some of these. 1. Taking advantage of tax deductions. Tax deductions are incentives offered by the government to reduce the amount of taxable income individuals and businesses have to pay. They are a way for the government to encourage certain activities and can be used by both high-income and low-income taxpayers. The rich take advantage of these deductions in a variety of ways. For example, they can use the mortgage interest deduction, which allows a homeowner to deduct the interest they pay on their mortgage from their taxable income. This deduction is most beneficial to those with higher incomes, because they are likely to have a larger mortgage balance. They often also use deductions for business expenses. This can include expenses such as advertising, travel, and entertainment. Overall, the rich smartly use this option as an effective tool to legally avoid paying taxes. 2. Taking advantage of tax-advantaged accounts. These are investment accounts that provide tax benefits to help individuals and businesses save for retirement. The most common types are 401ks and IRAs. These accounts are designed to help both individuals and businesses reduce their tax burden and maximize their savings. Contributions to these accounts are often tax-deductible, meaning that the amount contributed is not subject to taxation in the year it is made. In addition, any earnings on the investments inside the account are not subject to taxation until the funds are withdrawn. For individuals in higher tax brackets, this can be a major advantage, as they can defer taxes on their income and investments until a later date. An example would be Roth IRAs, which when withdrawn are not subject to federal income taxes. This, as you can see, is very beneficial for the rich. 3. Taking advantage of tax shelters. Tax shelters can be of many kinds. Tax credits are a popular tax shelter. These are amounts that can be subtracted from the amount of taxes owed. For example, there are credits available for higher education expenses, energy-efficient home improvements, and retirement savings contributions. Another example is the use of depreciation that allows a business to spread out the cost of an asset over its useful life. This can significantly reduce the amount of taxes that must be paid in the year that the asset is purchased. Using specific investments, such as real estate, to decrease taxable income is another trick used by the rich. 4. Investing in municipal bonds. These bonds are debt investments issued by local and state governments to finance various public projects, such as schools, highways, and water and sewage systems. They are attractive investments for the rich, because they are one of the few investments that provide tax-free income. The income earned from these bonds is exempt from federal income taxes. Furthermore, some states may offer additional tax incentives for purchasing such bonds. Another way is by investing in municipal bond mutual funds. These funds are managed by professional fund managers. By investing in a bond like this, the rich can diversify their portfolio and spread out the risk of investing in just one bond. Importantly, the income earned from these funds is still tax-free. Finally, the rich can invest in these bonds through a tax-sheltered retirement plan, such as an IRA or 401k. By doing this, they earn a tax-free income while also deferring taxes on the earnings until they are withdrawn during retirement. 5. Using tax loss harvesting. This is an investment strategy used to realize capital losses to offset capital gains, as well as to reduce tax liability. To use this strategy, investors identify stocks or other investments that have declined in value since they were purchased. They then sell these investments to realize the capital losses, which can be used to offset capital gains or to reduce taxable income. Tax loss harvesting can be particularly useful for high-income individuals and families, who typically face higher marginal tax rates. Using this strategy, these individuals can potentially save thousands of dollars. For example, if an investor has realized a $10,000 capital gain, they can use tax loss harvesting to offset that gain by realizing a $10,000 capital loss. This would reduce their taxable income by $10,000, resulting in a substantial tax savings. This can also be used in conjunction with other tax-saving strategies. For instance, investors can use the losses to offset gains from other investments, such as mutual funds or REITs. Another way the rich use it is to offset income from sources, such as wages or business income. Most importantly, the losses can be carried forward to future tax years, allowing investors to continue to benefit from them in the future. These are some of the smart ways the rich are employing to keep nearly all of their money for themselves, and that too legally. We on our part would insist that wherever possible, you too try some of these strategies to save your money, as that would ideally serve the purpose of this video. Also, please don't forget to check out our video on budgeting your paycheck. It will greatly help you manage your finances in these times of high inflation. You will find the link to it at the end of this video. If you found this video useful, only then do we insist that you subscribe and also like and share the video. Thanks, and have a great day.